The Dow rising by 553 points.
Wall Street pushed higher to start a new month.
Stocks rising yesterday with the Nasdaq closing at its highest level since late February.
The S&P 500, which tracks 500 large publicly traded companies in the U.S., surged 40% from its low point in March through the beginning of June. The stock market and the economy haven't always moved in tandem, but the recent separation between the two has been especially stark. The result is a growing divide between Wall Street and Main Street.
If there was any doubt before, there should be no doubt now that we have completely divorced the economy from the stock and the bond markets.
Some investors warn the market is too hopeful as businesses and consumers face extraordinary uncertainty from the pandemic and social unrest.
I think the market is overvalued. I think it's almost impossible to predict where consumer and corporate demand is going to come from.
Others say the market's right to keep moving higher as the economy reopens and policymakers stand ready to provide more economic stimulus.
It doesn't matter what happens to fundamentals. It doesn't matter what happens to corporate earnings. It doesn't matter what happens to economic growth, because the Fed will buy what I want to buy. That's the mindset of the market right now.
So how can stocks move higher with the economy in such bad shape? There's a saying among investors, the stock market isn't the economy. The stock market offers a window into the economy by tracking publicly traded companies. But plenty of Americans work for companies that aren't public, and they spend money on goods and services that aren't directly reflected in the stock market. Another key difference is the stock market tries to predict what will happen in the future, while economic data reflects what's happened in the past.
The stock market is a bit of a leading indicator because investors are looking forward and doing a forecast, and the stock market is the collective forecast of all those investors.
When the stock market goes down, more investors are selling stocks than buying them. That means collectively, traders are less optimistic about the future prospects of companies' earnings and the overall economy.
It's not reflective of how the economy is doing today, but how the economy and businesses are going to be doing 3, 6, 9 months from now.
The financial crisis from 2007 to 2009 helps illustrate how the stock market is a forward-looking indicator. The S&P 500 hit a bottom in March 2009, then rallied more than 60% by the end of that year, as investors became more optimistic about the economy. During that same time, the unemployment rate continued to rise, ultimately peaking at 10% in October 2009.
When you go back to March of 2009, when the market eventually bottomed, the news was getting worse. The news wasn't getting incrementally better, but stocks stopped going down. Stocks had efficiently priced in what they thought was worst case scenario and started looking out to a future that was modestly better.
Most economic data, on the other hand, give a look back in time. For example, official GDP data for the first quarter, which reflects economic activity in the first 3 months of the year, is typically released in April. It takes government officials time to gather and analyze information about consumer spending, business investment, and other key metrics.
When we get the first quarter GDP numbers, we're always like, oh wow, that didn't look that great. The first quarter, by the time you get that, you're halfway through the second quarter. So yeah, economic data by its nature is backward looking.
In the short term, the stock market is much more volatile than the economy. The Dow Jones Industrial Average might swing thousands of points from day to day, even as the economic data stays the same. Plus, it's not just economic data that moves stocks. Factors ranging from geopolitical tensions to politics to trading algorithms can affect market moves.
At any given point in time, the stock market may not be a good representation of anything other than the collective sentiment of the people that are participating in that market.
The forward-looking nature of the stock market is one reason why stocks have surged in recent months, even as the economy has collapsed. While jobless claims spiked in April and May, some investors expect employment will bounce back later this year as the economy reopens.
Investors continue to be optimistic over the gradual reopening of the economy.
Protests, curfews, and property damage are complicating the reopening in many cities, but not enough yet to change the general expectation of increased business activity through the summer.
Many traders are pinning their hopes on positive developments toward a COVID-19 vaccine, which would speed up the economic recovery.
What's it worth to get a vaccine or hopes for a vaccine? About 35 points on the S&P. Look at that, 730. Moderna came out and we just went straight up from there.
I would argue that healthcare news right now is more important than economic data and earnings. And I think that's going to be the case for a while. And the real reason behind that is this is a pandemic that will end when we feel comfortable going back out into the public.
Historically, the stock market benefits from signs the economy will improve, even if it's not happening right away.
Markets have actually done very well when really bad news gets less bad. And we suspect that we're going to see that incrementally that news gets less bad in the coming months and the coming quarters.
Bad news for the economy or the average American can also translate into good news for individual stocks. The share price of Uber, for example, surged 9% in one day in May after the company announced layoffs and cost cuts.
When wages are low, which they've not been doing very well, profits are high. Stock market loves high profits and low wages, but the economy doesn't like low wages. You don't have people to buy your goods and so forth.
Many stock market investors have also been encouraged by aggressive stimulus from the Federal Reserve and Congress.
What we've been able to do is to help markets return to more normal functioning, which has the effect of buying time for healthcare professionals, buying time for governments to respond.
Since mid-March, the Fed has lowered interest rates to zero and bought trillions of dollars of assets. Low interest rates encourage companies and consumers to borrow money at a low cost.
The Fed is all in. They're telling as strongly as they possibly can investors that interest rates are going to remain near zero for a long, long time. So if you're a stock investor listening to that, that's a signal that there's a limit to your downside, that there is a floor under stock prices.
Congress has also authorized trillions of dollars of economic stimulus during the crisis.
The government has put almost $3 trillion of money into the economy. Some of that money is finding its way into the market.
With interest rates and bond yields set to remain low for a long time, some say investors have no other choice but to put their money into stocks. One study even found some Americans use their stimulus checks to invest in the stock market.
Low interest rates leads to high stock prices. People don't want to put their money into bonds, they want to put their money into the stocks.
Another explanation for why stocks have surged despite high unemployment requires a closer look at the stock market itself.
A handful of companies really disproportionately perform and inflate the equity markets.
5 stocks account for around 20% of the overall market value of the S&P 500. Those 5 companies are Microsoft, Apple, Amazon, Google parent company Alphabet, and Facebook, 4 of which have market valuations above or near $1 trillion. These stocks have rallied big time over the past 3 months, giving a boost to broader markets.
Think about those companies and how much more business they're doing because we're working from home. That's been part of the leadership that's driven this market. So some of the drivers of the market's performance off of the lows has been companies that are actually doing very well in this environment.
Other smaller tech stocks have also benefited from stay-at-home orders. The share price of Zoom has nearly doubled over the past 3 months.
You can't just say, well, we shut the economy down, so the market should be going to zero. You have to look at it like, what is keeping us going during this current environment, and are those stocks outperforming? And I would offer up they probably are.
By some accounts, the gap between Wall Street and Main Street now looks wider than ever. Many retail investors have kept their cash on the sidelines as they try to wait out this economic crisis, meaning they haven't benefited from the recent bounce back in markets.
There's a lot of people that got out of this market and are staying out, making an assumption that either we have to test that low again or things are actually going to get worse, not better.
Many aren't invested in stocks in the first place. Only 14% of Americans are directly invested in individual stocks, while 52% have some level of investment thanks to 401k or retirement accounts. Among those who earn over $100,000, stock ownership is much higher at 88%. So gains in the stock market disproportionately benefit wealthy Americans. This chart shows how the longer-term link between stocks and consumers has been broken in recent months. Consumer sentiment plunged from February through May as the S&P 500 rallied. Some say the stimulus efforts from the Fed and Congress have benefited big companies and Wall Street more than average Americans.
The problem wasn't just the amount of money, it's how the programs were designed. The money didn't go to where it was most needed.
Others warn the stock market has risen too much, given the outlook for the economy during the pandemic.
Stock investors have gotten ahead of themselves. They're putting too high a probability on a V-shaped recovery.
The economy and the markets have gone through other phases where they're not in lockstep. Take, for example, in 2018.